Welcome to the week that was, where we try to sift through all the chaos in the financial markets to find, well, the signals that actually matter. And if you blinked last week, you really might have missed it. A truly profound moment of contradiction in the digital asset world.
It really was.
We saw two totally separate realities just running in parallel. On one side, you had this gut-wrenching price collapse, sheer panic, a move that has erased over $1.2 trillion from the total market cap. And that's just in the last 6 weeks. It's a staggering number.
It is. And, that volatility is what's grabbing all the headlines. But that's really just the surface noise, the short-term price action. Our mission today is to look through that volatility. Because beneath the surface, what we're actually seeing is the structural foundation of this entire asset class. It's accelerating. It's maturing right in front of us.
So this is the great divergence you were talking about.
Exactly. This is where let's call them weak hands, the speculators, they capitulated en masse. And at the same time, the strong hands, corporate treasuries, major infrastructure providers, they moved in aggressively.
So we're going to try and separate the fear from the build-out.
That's the plan.
Okay, let's start where the pain was most visible then, the price action.
Feel it.
The technical damage it's just undeniable. From that October peak, we saw a massive drawdown, over 24.6% in a flash. Bitcoin just hemorrhaged through those key psychological levels, 94,000, then 90,000.
Gone.
And it ultimately hit a new 6-month low.
Yeah.
I think the price flirted with, 80,553 intraday?
That's right. And the consequence of breaching those supports was really significant. Bitcoin officially erased all of its year-to-date gains for 2025.
So for a moment, it was actually negative on the year.
For a brief moment, yeah. It was trading at around minus 2%. And suddenly gold, which is up over 36% year-to-date, is comfortably holding that top performer title.
And that shift tells you everything about where institutional capital was flowing.
It tells you exactly how risk-averse they became overnight.
And the sentiment metric we track, the fear and greed index, it just plummeted. It went down to 10.
10. That is the literal definition of extreme fear.
A level we've only seen in these huge crises like the March 2020 COVID crash or the FTX collapse. What's so telling about this particular score?
Well, it measures the emotional state, right? But what's fascinating here is that the panic was confirmed by the technical systems that, traditional finance uses.
The algos.
The algos. We saw the confirmation of the infamous death cross on the daily charts. That's the 50-day moving average dropping below the 200-day.
So for trend-following funds, that is an automatic sell signal.
It's an immediate, automatic risk-off trigger. It doesn't matter what the fundamentals are. The signal hits and the selling starts.
So it's not just a scary name. It is a mechanical switch for massive amounts of capital.
Exactly. And when those algorithms flip, they force the market lower, which in turn triggered these massive leverage washes. We saw over $2 billion in liquidations across the crypto market.
As those supports just failed.
They failed. And it was brutal, but we need to remember that this forced selling primarily clears out the highly leveraged long positions.
You often talk about this as being a sort of necessary cleansing.
It is. Excessive speculation, it just makes the market fragile. So this period of cascading liquidations, as painful as it is, it leaves a cleaner, deleveraged foundation.
Right.
It means the remaining buyers are holding for, reasons of higher conviction, not just short-term leverage. It washes out the weak hands.
So what lit the fuse then? What started this sudden rush to get risk off? It wasn't just the technicals. It felt like the entire macro picture just turned sour.
It absolutely did. Okay. And the central driver was uncertainty around the Federal Reserve. The market-implied probability of a December rate cut just collapsed.
Right. It went down to about 40%.
From much, much higher levels. The whole dovish pivot narrative just evaporated. And it's because the Fed was basically flying blind.
And this was because of that strange data vacuum, right?
Mm-hmm.
The government shutdown meant a key report got canceled.
Precisely. The October unemployment rate. That's one of the two main data points the Fed uses to guide policy employment and inflation. Without that piece, the market panicked.
And assumed the worst.
It priced in the worst, a hawkish hold. That uncertainty forced institutional de-risking and a rotation out of anything sensitive to interest rates.
And you could see that rotation happen in real time in the ETFs. The aggregate daily capital flight from the U.S. spot crypto ETFs hit what, $903 million in one day?
On a single day. When you see volume like that leaving, you know, the tourist capital, as they call it, is fleeing for the exits.
The magnitude of it is just, wow.
It is. I mean, BlackRock's IBIT alone, one of the most popular funds, recorded a $523 million net outflow in one session. That is mechanical selling at its purest. These big TradFi allocators, the hedge funds and family offices, they're viewing Bitcoin as what we call a high beta macro asset.
Could you unpack that for us? What does high beta macro asset really mean in this context?
Sure. It means they see it as a leveraged bet on the global economy and monetary liquidity. When things look good, they buy it aggressively because it tends to amplify gains.
But when the Fed is uncertain.
Exactly. When the Fed is uncertain and the U.S. dollar is strengthening, they treat it like the riskiest stock on the board. They sell it first and rotate into safer things like cash or gold.
So for them, it's not an independent hedge yet. It's just a pure risk-on, risk-off play.
That's what the flows suggest, yes.
Yeah.
It's a pure risk asset for that class of investor right now.
And then just for final punctuation mark on the psychology, we saw that classic retail capitulation signal. Financial personality Robert Kiyosaki.
Ah, yes.
Famously a Bitcoin bull, publicly announced he was selling $2.25 million worth of Bitcoin around the $90,000 level.
To rotate into real assets.
Exactly. I mean, that is the kind of public panic that historians are going to point to as the bottom of the emotional cycle.
It's a textbook signal.
So here is where that divergence becomes so compelling. While the ETFs were hemorrhaging capital and retail was panicking, the strong hands, the corporations, were moving in the complete opposite direction.
Accumulating aggressively.
Let's start with MicroStrategy. Their high-velocity accumulation strategy is just something else.
It really is. I mean, MicroStrategy is executing what you could call the ultimate corporate Treasury Firewall. They upsized and completed a staggering $3 billion offering of 0% convertible senior notes.
$3 billion.
With a B. And those funds are explicitly earmarked for buying more BTC.
Okay, hold on. Issuing $3 billion in debt, even at a 0% coupon right now?
Yeah.
In this market? That sounds incredibly aggressive. What are the major risks there if this bet goes wrong?
That's the right question to ask because the risk is absolutely real. It's a high-conviction, high-leverage bet. They're betting that the cost of servicing that debt, which is basically free money, will be far outweighed by Bitcoin's long-term appreciation.
But if it drops further, say below 50,000,
then they could face significant balance sheet pressure, maybe even margin calls on other collateralized loans. But here's how they see it. They view fiat currency as having a negative real yield because of inflation.
Right.
So by borrowing $3 billion at 0%, they're turning depreciating dollars into what they see as a scarce appreciating asset. It positions them as a buyer of last resort in these panics. Their total holdings are now at, what, 649,870 BTC?
Which is over 3% of the total supply, just removed from circulation.
A huge supply sink. And we're seeing this high conviction thesis expand. It's not just them.
Right. Marathon Digital issued $700 million in notes,
mimicking the MSTR strategy. And over in Japan, Metaplanet secured a $100 million loan for accumulation. This isn't just one company's wild bet anymore. It's a strategic corporate movement.
Even El Salvador bought the dip.
Bought another 1,098 BTC, reinforcing that sovereign commitment.
Now, this aggressive accumulation, it's a positive long-term signal, but it's also creating some tension in the legacy financial world. I'm thinking about that warning from J.P. Morgan.
That's the critical counterpoint.
Yes.
J.P. Morgan issued a stern warning that this very strategy exposes MicroStrategy to legacy index risk.
What does that mean?
If MSCI, the index provider for massive institutional funds, if they change their rules to exclude companies whose assets are primarily digital holdings,
MSCI could get kicked out of the index.
And that would trigger a forced selling event. J.P. Morgan estimated it could be anywhere from $2.8 billion to $8.8 billion from passive index funds that have to sell.
So their very aggression puts them at odds with the old rules.
That's the conflict in a nutshell. Crypto growth is clashing head-on with legacy finance's index rules.
Wow.
And meanwhile, on the supply side, we're also seeing capitulation. The hash price miner revenue, it collapsed to an all-time low, under $35 per petahash per second.
Which is crushing for the inefficient miners.
It forces them offline. which reduces the constant sell pressure from miners who have to cover costs. It's another cleansing of the market.
But the efficient ones are surviving.
The efficient ones are showing incredible resilience. HIVE Digital reported Q2 revenue growth of 285% year over year. And that was partly driven by diversifying into high-performance computing.
Oh, the AI compute services.
Exactly, hedging against pure Bitcoin volatility. The industry is maturing past a single revenue stream.
Okay, let's talk about the most powerful long-term signal of all. The regulatory and infrastructure build-out that was happening while the market was melting down. It's almost surreal.
The contrast is jarring, isn't it? In the U.S., we saw this unexpected acceleration in regulatory clarity. SEC Chair Adkins's Project Crypto proposed a system where tokens can evolve into commodities as they become more decentralized.
Which is huge. It gives a clear compliance pathway. It's a move away from just regulation by enforcement.
And then we got the Trojan horse ruling from the OCC, the Office of the Controller of the Currency.
Okay, this one seemed deceptively simple. It lets national banks hold crypto just to pay for network fees, or gas. Why is that such a game changer?
Because it forces their hand. The OCC is mandating that if a bank wants to interact with a decentralized blockchain for any reason, custody, transfers, tokenization, they must be able to natively interact with that network.
Which means paying the fee in the network's own crypto asset.
Precisely. So it forces them to build or license the custodial infrastructure and compliance pathways to interact directly with these ledgers. It removes a massive hurdle and paves the way for institutional tokenization.
And at the same time, the global rails for traditional finance got a major upgrade.
That's the go live of Swift's ISO 2022 messaging standard. The old system was like sending a postcard with just an amount on it. This new standard is like sending an entire database entry with the payment.
So it integrates rich data.
And it natively integrates ISO-compliant utility tokens like XRP, XLM, HBAR into the global banking system. It just lowers the technical friction for banks to use these assets.
And this build-out is clearly responding to demand. I mean, look at Charles Schwab. Over $9 trillion in client assets.
And they confirm plans to offer spot Bitcoin and Ether trading to their retail clients sometime soon.
The retail floodgates are about to open from the big, trusted incumbents.
They're responding to overwhelming client demand. It's a global thing, too. Look at Asia. Binance Japan launched a direct integration with PayPay.
Japan, the largest cashless app. 70 million users.
70 million users now have a frictionless 247 on-ramp to regulated crypto trading, validated by one of the world's strictest jurisdictions.
And finally, it's not just about Bitcoin and Ethereum anymore. Fidelity just launched its spot Solana ETF.
FSOL, with a competitive 0.25% fee. That's a huge signal that institutional allocators are positioning for a multi-chain future. They see other layer ones as viable investments.
And Coinbase backed that up by acquiring Vector, a Solana-based trading platform.
As part of their everything exchange strategy, the ecosystem is expanding rapidly.
What a week, just defined by contradiction. You have record ETF outflows pushing prices to 6-month lows. And at the exact same time, corporate treasuries are issuing billions in debt to accumulate, and global regulators are laying the rails for long-term adoption.
It's a violent market reset, but the strong signal of adoption has never been clearer.
The conflict is just perfectly defined by that tension, isn't it? Short-term price versus long-term adoption.
It is. And as we discussed, even these aggressive accumulation strategies carry real legacy risks, like that potential forced selling MicroStrategy could face if MSCI changes its rules. That conflict legacy rules versus new assets, that is the friction point right now.
So, as a final thought for everyone listening, you've seen the classic technical sell signal, the death cross, confirming the downward momentum. And you've seen the classic contrarian buy signal, the extreme fear score of 10.
A psychological bottom.
Potentially. The price pain is intense, with analysts mentioning $75,000 as a possible downside target. If the price keeps falling, will you focus on that potential floor, or will you focus on the progress of, say, Senate Banking Committee Chair Tim Scott's push for crypto legislation in December? The choice between the short-term noise and the long-term signal is rarely so stark.